Good afternoon, this is Peter Towers from ESS BIZTOOLS. Welcome to this webinar on business advisory services selling a business. Thank you for attending. We've got people from all over Australia, so welcome to this special webinar. If you have any questions as we're going through the material, can you please type in the question, and in the webinar jargon, raise your hand, and I will try and answer the questions at the end of the webinar. There's just people still logging on, but while they're doing that, we'll start moving through. So when you first go to the ESS BIZTOOLS website, you can click through to products, and within products we have advisory services, client mentoring, leadership, business plus, and the ESS papers. So where we're going to today is in business advisory services, into business advisory services. What's on the left-hand side of the page is the material that we have in separate modules to help an accountancy business prepare themselves to offer business advisory services. And on the right-hand side of the page is the actual products which we've developed. And the one we're going to today is down near the bottom is Selling a Business. When you click on, you will receive an executive summary of the material that's within that particular paper, together with all the forms that are attached, which will assist you to offer professional advice to a client on preparing themselves to sell a business. So we're just downloading that now. We're downloading it in Word format. It just takes a little bit longer than what it does in a PDF format. If you wanted the PDF format, you would just click View. And in the first instance, what we're going to bring up is the PowerPoint slides. And we'll go back and look at the paper itself very soon. So we just move into it now. Our whole concept is that you would have had, first of all, had a meeting with your client, and we call that a one-on-one meeting, and you've used the Sme Needs Analysis, which is really a menu of the services that can be made available to the client, to have a conversation with the client on the type of services they need undertaken. And obviously from this activity, we're assuming that the client has indicated that they would like to have a review undertaken to assist them to sell their business. So they've asked you to prepare a selling a business consultancy. So what's covered in this consultancy? What have we included to help you deliver this professional service to your client? Well, there's a number of forms. We have a consultancy control form, which we'll go onto the site and show you shortly. We have a document which we call What's the Current State of Play? What's the current situation within the business? Is this just a one-man band? Are there any systems? Where's the intellectual property? Is it all in someone's head? Getting ready for sale. Deciding to sell a business today and wanting it to be on the market next week is not very smart in the current situation. There are literally thousands of businesses for sale as the baby boomers get ready to retire. But in addition to that, of course, there's always businesses for sale, and so there's always a buying and selling going on of businesses. But at present, of course, we've also got some fairly difficult economic circumstances around Australia. and a lot of uncertainty about a particular event called an election. We don't even know when the election's going to be held now, and unfortunately, having announced an election back in January, the then Prime Minister has set the seeds for a lot of uncertainty in business, so it's not really a good time to be trying to sell a business. And we're going to go through some of the items to consider in the sale of a business. We're going to raise the question about a sales retention bonus for key employees. And can the business run without the owner? Is it necessary to clone the owner? What's the business's valuation? What do you think it's worth? What's the client think it's worth? And therefore, what is the valuation gap? And then what's got to be done about that gap? The gap could be millions of dollars. Opportunity to present a program to the client to say, let's clean up the profit and loss account and get the business into a more investment ready status. We raised some questions and comments about how a public company is valued, and asked questions as to whether a price multiplier closer to an initial public offer could be used, and what would need to be included within the business system to enable an arm's length external purchaser to be prepared to pay up around 8, 9, 10 times after-tax profits rather than only 3 or 4 times after-tax profits. We have a due diligence checklist. We have a list of what you might need from the buyer. There's a confidentiality agreement included. There's a draft of a sewing memorandum. There's a list of some of the taxation issues. And we've also referred to some of the reference papers that the seller might like to read, bearing in mind your client might have only done this once or twice in their career, or they might never have tried to sell a business. Perhaps they need to do some reading. So that's basically the introduction. There is full PowerPoint slides which you could utilize to review the total system. We're now going to download the paper we're referring to in a Word document. So this paper includes a general summary of a whole range of matters. It also includes a quotation form and a proposal document to assist you in submitting a proposal to the client. But where I really intend to go through today is within the documents themselves. And we're having trouble getting it to link here. Just a moment and we'll... Okay, so the first one I'm just going to show you is the Sme Needs Analysis. This is the menu of services. You can first of all review the current work that's been undertaken for the client or current activities, and then you would go into some of the other activities, and it's from the use of this sort of document that your clients identified that they'd really like some assistance on being able to sell their business. The Selling a Business Control Form is a document that allows you to control this whole process. So if you wanted to have a look at what we're calling state of play, it's a questionnaire that enables your accountant who's undertaking this assignment for the client to first of all review what changes are necessary, what can be done to improve the value of the business. If there are going to be any changes made, staff, if things got to happen to customers, suppliers. Why is the business for sale? What about the margins? What impediments are there to selling the business? What's the reputation? What's the business's unique selling proposition? What differentiates this business from its competitors? How does this business compare to any of the benchmark reports that you or the owner has? What's the corporate culture like? And what's the action plan? Can this business be immediately sold, or is it going to be an activity that might take 2 to 3 years to get ready? So coming back to the main control form then, is the business ready for sale at present? Quite frankly, in my opinion, most businesses are not ready for sale the day the owner walks in and says, I want to sell my business. So what strategies are going to need to be implemented? So we've already looked at that one, sorry, I went to the wrong one then. If you're selling shares in a company, we think it's a good idea that you undertake a due diligence checklist first. So we've got a very detailed company due diligence list. Because if you're like me, most accountants get a bit nervous about one of your clients buying shares in a company. But if that's the only way the business is able to be sold, because the ongoing entity requires this corporate structure and what's being sold is shares, someone's going to come in for a purchaser and want to undertake a due diligence review. Our proposal is it's best for you to undertake the due diligence review for your client prior to someone else turning up wanting to do the due diligence review. So this due diligence review on a company goes on for about 30 pages, listing all sorts of issues relative to a company as if you were going to sell some shares in it. So that if there are any issues, in particular if there's things that need to be fixed prior to having a representative of a potential purchaser going through and looking at a business, well, you can do so now. And then when they return later on, it won't be an issue. So that due diligence list covers a wide range of matters. What items do you need to consider in planning the sale of a business? Is this a business that the key staff are going to be required by the purchaser? In most cases they will be. Are they going to get nervous because of the sale of business? Should you be thinking about offering them staff retention bonuses to remain with the business for 12 or 18 months after the sale? So what is the key person risk? Does any of the family want to own the business? And what are the following questions there is, how are they going to pay for it? Can the business be effectively run without the owner? Can someone be cloned? So these are the sort of questions that we believe you should be going through and looking at. We have a format for looking at a staff retention bonus. That you might be able to use if that's important. What about the business valuation? What's the owner think the business is worth? Should you be preparing quite separately a business valuation? And what's the valuation gap? And obviously when you're looking at the business, you've got to look at it from a potential acquirer's point of view. What changes need to be made to bridge that gap? And how long is it going to take to implement those changes? In lots of cases it may take 1, 2 or 3 years. What's happening with the intellectual property of the business? Is it properly documented? What patents does the business have? Is there any recent research that could be patented? Trademarks, brands. Have the systems been documented? These are the key things that will affect the overall valuation of the business. the goodwill of the business, the multiplier that will be used on the after-tax profits. Whichever way you express it, it all gets back to the added value that the purchaser is going to receive. Is there a need to clean up the profit and loss account? Are there personal expenses going through the P&L account that require a whole range of reconciliations being prepared? Why not get rid of them? Why not have a clean set of accounts for 2 or 3 years so that there is no question marks? How could you improve the multiplier? Well, we've got a bit of an example there. Normally, a share in a private company is going to have a multiplier of about 1/3 of the public company average, which traditionally in Australia is around 15. That means the multiplier of the after-tax profit would be 5. But if a company is doing an initial public offer, the multiplier that's normally applied is around 2/3 of the listed public company. So we just have a brief example there that you might like to tell your client. By valuing the business at the normal multiplier, a business with an after-tax profit of $400,000 would be worth somewhere normally around $2 million. But if appropriate systems were implemented, systems manuals, protection of intellectual property, full documentation, the business appeared very clean in how it's run. Maybe the accounts are audited. Maybe there's been a significant improvement in corporate governance. Then it is arguable that the multiplier could be somewhere between, in this case, 5 and 10. And just by way of example, we're saying there, of course, if 10's used, the business valuation has been doubled. Where's that extra $2 million? It's basically in the perceived value of the business because it has adopted more systems similar to what might be adopted by a public company, and purchasers will pay more, especially if they are public companies or major corporations. Bearing in mind, if they buy a business at 7 times its earnings and it goes into their financial accounts and they're currently being valued at 15 or 16 times earnings, that new business very quickly has appreciated from 7 times to 15 or 16 times earnings. What are some of the impediments to the valuation? And we've listed some items there that you might use as a checklist. Gross profit percentage. Maybe the turnover is declining. Wages to turnover might be too high. Rent. Stock turn. Is there too much money tied up in stock? Are the debtors' days outstanding too high? You know, are they even higher than the Dun & Bradstreet national figure of 55 days at present? Work in progress. Is there reliance on too few customers? These are some of the issues that you might want to look at in having that conversation with your client as to what changes might have to be made so as to maximize the value of the business. And hopefully a sheet like that will help. We have a separate paper on strategies to bridge the valuation gap, which is talking about the systems manuals, intellectual property protection, perhaps having an auditor. If you were going to do an IPO, your client has to have an audit for 3 years in any case. But it could be a good investment to be trying to get a higher price earnings multiplier applied. Should you have 1 or 2 external directors to improve the process? The system includes a due diligence review checklist. Now this is just a due diligence now on a business, forgetting a company. What's a buyer likely to want to check? We've got there virtually everything. So we have a list so you can discuss this with your clients and make sure that all these records are going to be available for the purchasers' advisors to review. Now normally the purchasers' advisors will be their accountant, solicitor, and perhaps the business broker. So they're going to be getting informed people to tell them about some of these issues. So planning considering the issues on a sale, planning it. Is it the right time to sell? What is being sold? Is it only the business? Is it the real estate? And what involvement's the vendor going to have in the sale? Is the vendor prepared to be available for 2 to 3 months after the sale? These are the type of discussions that we think you should be having first, so that some strategy is determined from you and your client. You need to make the sale known. Are you going to appoint a broker, or does your client know someone who might be interested in the business? So you go and have a cup of coffee and have a discussion. At some stage, suppliers are going to have to be told, and perhaps it's a good idea to tell the competitors, because one of the competitors may in fact be a very interested buyer. You need to start having the conversation with your client as to how they might get paid. Cash, shares, especially if they're dealing with a public company, the offer may well be to accept shares. And also they need to be conscious of the situation that they may be asked to supply vendor finance. And if that's the case, they need to know a lot more about the purchaser than what they may have been originally inclined to find out. Because if the person's going to owe them a substantial amount of money and going to pay it off over a 3 or 4 year period, you'd want to check out the bona fides of that person. Obviously timing is very important. We're proposing that if this is the situation, you'd be wanting to prepare a selling memorandum, and we have some guidance as to what should be in a selling memorandum. So what's the selling memorandum trying to highlight? Now, in some instances, you may even have a marketing, advertising, branding consultant prepare this, but we're assuming here that you, as the accountant advising your client on selling their business, are able to prepare most of this document. Some of it you may have to get input from other people. And there's some of the items which we believe you would be covering. And you'll also have some graphs and charts to highlight the key attributes of this business. We have a confidentiality agreement included in the system, which should be drafted by your client solicitors, but to give them an idea of the sort of things that might be covered, we've included a confidentiality agreement. We think it's important that the vendor does think about what he needs from the buyer, because, as I indicated just a moment ago, your client may have to supply vendor finance. So if the buyer wants vendor finance, it's reasonable to requesting statement of net worth, details of other loans that he or she has to pay. What's their projected cash flow from this business? They might be wanting to take out significantly higher salaries than what your current client, the vendor, is doing. So what are some of the issues that might be considered to finalise the sales contract? Obviously the price, the deposit, is it forfeitable or not? Who's going to be the stakeholder? The apportionment, payment. What's the contract going to say about things like staff, vendor assistance, warranties, suppliers, the lease? There's some of the issues that you might like to consider in advising your client on how to sell the business. What are some of the other issues for the vendor? Suppliers, close accounts, cancel guarantees. The number of times I've become aware of small business operators who are given guarantees to major corporations and then forgot to get them cancelled when they sold their shares in the business or left the partnership, and got a very nasty surprise a few years later when someone presented that guarantee, because unfortunately something had happened in the business. The major supplier hadn't been paid, and they were there seeking the guarantee. Now, it's not easy to get those guarantees back. It may have to be a condition of the sale that the current account that the business has is closed, and that your client's guarantee is released, and that the business then applies for a new account so that you can get that guarantee back. But it needs to be thought about. What's going on with the lease? Will the lessor agree to the assignment of the lease, or are there going to be conditions attached? Is your client still going to be financially at risk for the remainder of the current lease because the lessor will not agree to a full release? Obviously, guarantees from banks could be of some concern if it's a company and that your client is merely selling shares in the company. Is the bank going to be prepared to release his or her guarantee? Recovery of deposits made to various people. Decision needs to be made on things like holiday pay and long service leave payments. Have they been taken over by the purchaser? Obviously, the retention bonuses. And then some of the finalisation work that might need to be done. Workers' compensation, payroll tax, insurance policies. But just make sure that there's been agreement with the legal advisors and the insurance broker that it's as to the appropriate times to cancel various insurance policies. That can also cause some problems. Our material includes some reference material that you might like to supply to your client to read so they get a better understanding of this whole process of selling a business and how a business is valued, and some of the tax planning and capital gains tax issues that come into it. Remember what I said earlier, a lot of your clients will only ever sell one or two businesses in their entire careers. They're not used to going through this process. The other information which we have in the system is a form to assist you to prepare the quotation to undertake this work. So this is a form similar to what is included in the other business advisory services modules, whereby you can go through and look at all the various work to be undertaken. There are links back to those forms which include the detailed summary of the various assignments, so you can go through and estimate how long it is going to take to undertake that work for this client, so that you're in a position to prepare a quotation to go to your client. Now, these quotations for this type of activity can be quite complicated because it can be a fairly long-term project. So you need to make sure that you are going to incorporate appropriate milestone payments so that you have a payment schedule over a period of time. Or perhaps you break down the assignment into separate agreements with the client. To do that preliminary work, to do the valuation, that's one fee. Then you go into this strategy of assisting the client to bridge that valuation gap, and perhaps you give a quotation for each year's work. It should be in writing, and it should have the payment schedule attached to it. And we have for each of our business advisory services products within ESS BIZTOOLS a suggested proposal for undertaking this work. So this is obviously the proposal, the engagement letter for the assistance to a client to sell a business. So this is outlining what the quotation is, what the payment terms are. Obviously you can edit this. Be very careful in this type of assignment on any additional work that may emerge. In most cases there will be additional work. You need to be able to make sure that that is outside of this engagement. Submit a separate engagement letter to your client and bill it separately. Make sure you get the client to sign off in the acceptance of the quotation. Unfortunately, these types of assignments can lead to some disputes. The best way to cover yourself is to make sure the agreements are in writing. There is a payment schedule. There is a a facilitating payment, mobilisation fee, call it what you like, an upfront payment first, and then it's all done on progress payments being made. And obviously if there is a disagreement, you would stop doing any further work. So that's the summary on what's involved in the ESS BIZTOOLS material to assist a client to sell a business. I can't see that we have any questions. If you do have questions subsequently, please send us an email with the questions to peter@essbiztools.com.au.